Income tax is a tax that is imposed by a government on income earned by individuals and entities within its jurisdiction. It is one of the most important sources of revenue for governments, and it is used to fund a wide range of public services and programs. In this script, we will take a deep dive into what income tax is, how it works and what you need to know to navigate the complex world of taxes. First, let's take a look at what income is. Income is the money that an individual or entity earns from various sources, such as salaries, wages, bonuses, investments, rental properties and so on. Income tax is a tax that is levied on this income, and the rate of tax paid is usually determined by the total amount of income earned. The concept of income tax has been around for thousands of years. The earliest known example of an income tax system dates back to the ancient Egyptians, who imposed a tax on farmers based on the amount of land they owned. In modern times, income tax was first introduced in the United Kingdom in 1799 to fund the Napoleonic Wars, and it soon spread to other countries around the world. In most countries, income tax is levied by the federal government, although some countries may also have state or provincial income taxes. In the United States, for example, federal income tax is levied by the Internal Revenue Service, IRS, while state income taxes are levied by the individual states. In India, income tax is levied by the Central Board of Direct Taxes, CBDT, under the Ministry of Finance. The way that income tax is calculated varies from country to country, but in most cases, the tax system is progressive, which means that higher income earners pay a higher percentage of their income in taxes. Tax rates can range from 0 to as high as 40% or more, depending on the country and the income bracket. In order to calculate the amount of income tax that an individual or entity owes, it is necessary to first determine their taxable income. This is the income that is subject to tax, and it is calculated by subtracting any deductions, allowances or exemptions from the total income earned. There are many different types of deductions and allowances that can reduce an individual's taxable income, such as standard deductions. These are set amounts that are subtracted from the total income of all taxpayers, regardless of their individual circumstances. In the United States, for example, the standard deduction varies depending on filing status and is adjusted for inflation each year. Itemized deductions. These are deductions that are based on specific expenses incurred by the taxpayer, such as mortgage interest, state and local taxes, charitable donations and medical expenses. Tax credits. These are credits that can be applied directly to the amount of tax owed, reducing the overall tax liability. Examples of tax credits include the child tax credit, education credits and earned income tax credit. Once the taxable income has been determined, it is then subjected to the applicable tax rates to determine the final amount of tax owed. The tax rates can vary depending on the income level and other factors, such as filing status and deductions/allowances claimed. There are many different types of income tax, and each country has its own set of rules and regulations surrounding taxation. In the United States, for example, there are several types of federal taxes, such as income tax. This is the tax that is imposed on individual and corporate income. Social Security and Medicare taxes. These are payroll taxes that are collected to fund the Social Security and Medicare programs. Estate tax. This is a tax that is imposed on the value of an estate after someone dies. This can include audit. This is a tax that is imposed on the transfer of property from one person to another as offenses. To make sure that everyone pays their fair share of taxes, most countries have a system of exchange enforcement information between countries. This is aimed at reducing tax evasion and increasing government revenue, and it has led to the adoption of measures such as the Common Reporting Standard, CRS, and the Foreign Account Tax Compliance Act, FATCA. In conclusion, income tax is a necessary component of modern society. It provides the funding that is needed for governments to provide public services and programs, and it helps to ensure that everyone pays their fair share of taxes. While the world of taxation can be complex and confusing, understanding the basics of income tax is an important step in managing your finances and staying on the right side of the law. Thanks for watching! Make sure to come back for more video on financial success and practices. Make sure you like, subscribe and most importantly share.